Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by Oppenheimer Funds. Oppenheimer Funds has nearly 50 years of experience investing beyond borders to find tomorrow's opportunities. Find out more at oppenheimerfunds.com/global. Christine Ben's Portfolio Makeover Week is coming this fall. To be considered for a portfolio makeover, email portfoliomakeover@morningstar.com. Include your age, life stage, and some details, concerns, and goals for your portfolio.
This week on the podcast, 4 big fund upgrades and downgrades, what you should consider in a forever home, Telecom dividends, a fund pick in the non-traditional bond category, market cap weighted index funds are not broken, and 2 undervalued REITs. Let's get started. Here's Russ Kinnell with fund upgrades and downgrades.
From Morningstar, I'm Jeremy Glazer. I'm here today with Russ Kinnell. He's the editor of Morningstar's Fund Investor newsletter. We're going to look at some recent upgrades and downgrades that we've seen from our manager research team. Russ, thanks for joining me.
Glad to be here.
So you recently wrote a cover story for Fund Investor looking at some notable upgrades and downgrades for larger funds, and we're going to talk about some of the upgrades first. The first is Fidelity Strategic Income. Why do we have a higher view of, or a better view of this fund today?
Yeah, so we put a silver rating on this fund. It's actually new to coverage. This is our first rating, but we like that Fidelity's got a really deep team here. This is a fairly high-risk strategy. It's a multi-sector bond fund, meaning it's got a big chunk in high yield, emerging markets, high-yield bank loans, and then some more conservative holdings in addition. So you've got high risk in terms of issue selection, and then also you've got allocation because they're adjusting among those different types. That's a challenging job, but they've done a really good job of it, and we really think highly of the team, reasonable expenses. So it's a higher risk fund, but we have a lot of confidence in the managers.
Another upgrade was MFS Value. What changed there that improved our opinion?
You know, really in this case is an example of a fund where really nothing has changed. It's more just growing confidence, just growing evidence. Steve Gorham and team have been there for a while. We really like their value strategy. It's kind of value with a quality tilt, which means it gives it a little bit of a defensive nature. Hasn't been doing that well, really value relative to growth hasn't been doing that well. But if you look at the long-term record, it's really strong. MFS has a very deep analyst staff that we like. So this is just a solid fund that's gradually grown in our esteem. Really no actual change we can point to.
Let's look at some downgrades then. The first is Oppenheimer Global. What's changed here, or why are we less confident in this fund strategy?
Yeah, Oppenheimer is really a firm where their international funds are pretty strong, but you see a lot of key man risk because typically you have one manager with a small analyst staff and not a lot of support behind them. In this case, Rajiv Bauman is going to retire next year, and the people coming in place of Bauman are good, but they don't have the track record. They really were not in charge before, and so we've taken the fund down to neutral because of that. When an Oppenheimer manager retires, it's really a big deal. And of course, in the background, there's a report that Oppenheimer may be purchased by Invesco, so who knows if that would even affect the fund. The deal hasn't even been announced, so we're getting fairly speculative there, but we do know Rajiv Bauman is retiring.
And then another downgrade is a Fidelity fund, Fidelity Puritan. What's happening here?
Ray Irani is the manager at this fund, and he's really done a great job both in terms of he does the equity selection and the allocation selection, and he's going to retire at the end of this year. His replacement is someone who we rate his equity fund neutral, but also he doesn't have any experience with allocation. The fund is mostly equities, but also has some in fixed income, and the new manager will be in charge of deciding what that allocation is. So really a couple of question marks there. We don't expect the strategy to change, but will the execution be as good? We have questions. This is why we've lowered it to neutral.
Russ, thanks for the updates today.
Glad to be here.
From Morningstar, I'm Jeremy Glazer. Thanks for watching.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, what you should consider in a forever home.
Hi, I'm Christine Benz from Morningstar.com. What should you look for in your forever home? Joining me to discuss that question is Elise Glink. She's CEO of Best Money Moves, and she's also author of a new book, 100 Questions Every First-Time Homebuyer Should Ask. Elise, thank you so much for being here.
It's fun, thank you.
You've got a new edition of your book that is geared toward first-time homebuyers, great questions that they should ask before pulling the trigger on a house. I want to talk about a core demographic for us on Morningstar.com, though, which is people who are getting close to retirement or in retirement. And for a lot of people at that life stage, they're really thinking about, well, should I stay in this home or should I move to a different home where I maybe can stay throughout my retirement years? So let's talk about this idea of a forever home. First of all, is there such a thing as a forever home?
I think the word forever is different for everybody, right? I've been in my house for almost 25 years, and to some people that is the forever home.
Right.
And it might be my forever home. But I also think that, you know, when you're starting to think about retiring, what we mean also by forever home is, where is this going to be the place that you spend most of your retirement years? So one of the interesting things about the baby boomers is they started doing re-retiring. So the kids were gone, they retired, and they were like, oh, I'm going to move to the mountains. And then it was like, oh, 5 years later, I'm going to move to the beach. And then 5 years later, maybe their millennial children were giving them grandchildren. Oh, and Susie's over here in Boston now.
I'm going
to go to Boston.
Yeah.
And Susie moved back home. And, you know, so you have to kind of think about where are you going to be for sort of these 10 to 15 years before your kids have grandchildren or give you grandchildren. Or if you don't have kids, where are your friends going? Because this is the other side of it. You know, we're seeing that you may not have grandchildren or fewer grandchildren. Not all of your children may have children.
Right.
You may have grand dogs, like my neighbors do. But you may want to retire near where your friends are. And so we're seeing a real trend towards people retiring in clumps. Like they're all going to move out of this place, this town, and they're all going to go over here to this mountain town together, and then they go over here to this, you know, villa in wherever. So it's interesting to sort of look at what your future, your 25 or 30 years looks like, and make your list, like I say for my first-time buyers in the book, make your wish list, make your reality check, what you can't live without, and then take a look at your finances in retirement to see what you're going to be able to afford to do, and that should be where the conversation begins, with a bottle of wine.
Right. Okay. Good advice. So let's say someone is thinking that they actually want to try to stay put in one place. Let's talk about what sorts of things they should prioritize if they are thinking about staying in their home or thinking about relocating to a home that might be appropriate. What are some of the key features or amenities that they should be sure to consider? And of course, it's very individualistic.
It is, but it isn't, right? So when you move to the house that you raised your family in, school district is probably top of your list. It is for a lot of people. It should be if it isn't. But when you're thinking about your forever home, school districts are a lot less important. Not because your property isn't going to appreciate in value. If this is your forever home, you know, you may say, I'm pretty much dying in this house. You don't care as much about that.
Appreciation.
I mean, you don't. I mean, you care because you always care, but you really don't care in terms of sending your children to the schools and what's happening there. So as long as the school districts are fine, you really want to probably put health care and access to health care, access to public transportation. Maybe it's single level living. Maybe those knees are going.
You want it to be safe.
You want to be safe. You want to have a community that's important to you, and that might be a 50-plus community. You know, the Sun communities that are out there. Pulte has done a wonderful job with those. They're very, very popular. Appreciating nicely for those who live there.
But some people don't want that at all. And they want age diversity in their community.
Right, or maybe you want to live in near a downtown, which is near culture and nightlife and restaurants, and you want to recapture what you used to do when you were single or dating your spouse or partner, and be able to walk to everything and have this great city culture experience. Or maybe you want to live in the middle of an island, far from everybody. But whatever's important to you, that has to go down on your wish list, and then the reality check is, okay, but you do have to think about aging in place, what that means for the amenities in the house itself. Maybe it's extra wide doorways, the single level living, an extra room for a possible caretaker down the line, extra room for maybe visiting children and grandchildren. Maybe it means, you know, you need to be on a bus line so that you don't, when you can't drive anymore, that is easy access to transportation. So all of those things should be thought about.
Okay, so those are all sort of quality of life considerations. Let's talk about the financial piece. Some people have significant home equity. Should downsizing be sort of in their sights and as a way to enlarge their investment portfolio while potentially getting them into a more size-appropriate home?
So size appropriate is really interesting. The baby boomers have expanded their retirement
In
homes.
retirement, they're getting bigger.
They're getting bigger. They're buying bigger houses with more square footage. I'm not quite sure why. So this whole downsizing thing is interesting. I do think at some point in time, your forever home will be smaller than the 4,500 square foot house you might be living in today. And I do think that's what you're referring to, and I think that's appropriate. You just want less to take care of.
Right.
For some people, though, what they're doing is buying condos, and then they just want to travel in retirement. So a single family house, there are a lot of things to worry about in terms of maintenance. That's why maintenance-free communities are so nice. Some people just want to be in a condo or an apartment, lock the door, and take off.
Right.
So I think that all of those are considerations as well. The downsizing thing is interesting because, in terms of saving money, where you've been living the last 20 years, and this is actually a problem, a structural problem we're seeing in the real estate market right now, which is not enough homes in the market. People like me, whose kids are now just flown the nest, we should be downsizing or moving and leaving our homes. But it's so darn cheap to live there, Christine. The mortgage rate I have is so cheap. The amount I have to pay is so inexpensive. Yes, real estate taxes are high, but if I sold and moved to a smaller place, I'd probably pay the same or more and get less for my money. And so I think we're going to be seeing more people age in place simply because it's more advantageous. So if that's going to be the case and you like where you live, then you have to think about renovating your home to accommodate the sort of creaky knee syndrome.
Your needs as they unfold.
Yes.
Okay, Elise, always great to get your insights. Such an important topic. Thank you so much for being here.
Thank you.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, AT&T versus Verizon. Which is the better dividend play?
Telecom stocks are among the highest yielding in the market today, in the equity market. And AT&T and Verizon, the big two U.S. telecom carriers, certainly fit that bill. AT&T's yield today is about 6%. Verizon's at about 4.5%. Despite the fact that Verizon's yield's a little bit lower, we actually like that company and that stock better today. We think Verizon's focus on the core telecom business will position the firm well for the long term, especially if something unexpected happens in the telecom business. For example, the cable companies are potentially eyeing the wireless business and could get into the space at some point over the next several years. If wireless technology advances to the point that enables the cable companies to come in and disrupt the market, we think Verizon is positioning itself better for that to happen. Whereas AT&T has chosen to go a different direction. They've diversified the business across media and television, and we think that's pushed the firm in some areas where it's going to have more trouble competing over time. In addition, Verizon has a little bit stronger balance sheet than AT&T, which we think, again, protects that dividend and gives the firm a little bit more stability, whereas AT&T is going to be directing a lot of cash flow towards paying down debt over the next couple of years. Verizon, while also trying to pay down debt, won't have as much of a burden on its future cash flow coming from debt repayment as AT&T does. So despite the lower yield, we like Verizon here today. It's trading at about an 8% discount to our $58 fair value estimate, which is pretty similar to where AT&T's at. AT&T is trading at about a 9% discount to our $37 fair value estimate. So again, we prefer Verizon to AT&T, and we think it's an attractive play for dividend investors at the current market price.
This podcast is brought to you by Oppenheimer Funds. Oppenheimer Funds has nearly 50 years of experience investing beyond borders to find tomorrow's opportunities. Find out more at oppenheimerfunds.com/global.
Now, a great choice in the non-traditional bond category.
MetWest Unconstrained Bond is a great choice in the non-traditional bond category. Like most funds in this group, it is absolute return oriented and aims to downplay interest rate risk. Most funds in the category have some combination of credit, perhaps a lot of high yield and non-U.S. exposure and perhaps non-U.S. currency risk. This one is very focused on on credit, and that's a good thing because that's what this team has really done well over the long term, both here and on their flagship fund, MetWest Total Return Bond. In this fund's case, they focus more on non-agencies, for example, and more on credit and high yield overall. That's led to greater returns over the long term. And the team has also done a nice job navigating various stress periods for credit and rate risk since they launched this fund in 2011. So that's why we think this makes this fund a very good choice in non-traditional bonds.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, Ben Johnson says market cap weighted index funds are not broken.
For Morningstar, I'm Jeremy Glazer. With a handful of large cap names driving much of the market's return, many investors are wondering if market cap weighted indexes are at risk. I'm here with Ben Johnson. He's our Director of Global ETF Research and also the editor of Morningstar's ETF newsletter to explore this topic. Ben, thanks for joining me.
Thanks for having me, Jeremy.
So certainly it's eye-popping when you look at index returns and see just a handful of names, Apple, Amazon, really driving performance. Is this something that should concern index investors who have market cap-weighted indexes?
I don't think anyone investing in a cap-weighted index fund should be at all concerned about what's going on right now with respect to exactly that. The number of firms that are driving the market in one direction or another, because this is a feature of market capitalization weighting, and by no means is it in any way a bug. When you sign up for a cap-weighted index, you sign up for a very specific proposition, which is I am going to own a specific universe of stocks. The S&P 500, the Russell 1000, the crisp US Total Stock Market Index. And I'm going to weight the stocks within that universe on the basis of their going market capitalization. I am outsourcing, by way of owning a cap-weighted index fund, all of the heavy lifting as it pertains to understanding these companies' fundamentals and subsequently setting their prices to other market participants. I'm taking my hands off the wheel, putting things on autopilot, and doing so because over the long stretches of time, the market generally gets it more right than wrong. And because it's very inexpensive to do so, as measured by the fees that you will be charged by investing in these funds, as measured by their turnover, as manifest in their tax efficiency.
But how about valuations? When you see these big run-ups, you do wonder if they're justified, if these stocks are overvalued. If we're looking at, you hear some people describe it like the tech bubble again. Is that an apt comparison?
Absolutely. So that's not to say, going back to what I said before, is that along these long stretches of time, you won't be sort of nipped by bouts of mania, bouts of panic. And certainly the mania of all mania that we've seen, at least in recent history, was the tech bubble. And that was a period of time where, if you look at the S&P 500 in particular, it took, in 1999, 33 of the largest S&P 500 stocks to soak up 50% of the value of that index. So there was a huge degree of concentration within the index at the security level, greater degree of concentration still at the sector level. Tech stocks were on fire, and the valuations for those stocks were mind-bending. They were outrageous. Cisco was trading at nearly 200 times earnings. Now, if you fast forward to today, what you see is that to make up half of the current value of the S&P 500 index, it takes about 50 stocks. The long-term average is around 52. So concentration, again, which is more so a feature of market cap weighted indexing and not a bug, is within, at least by this measure, fairly normal ranges. Valuations, while in some cases quite high, certainly aren't nearly as elevated and out of range and completely out of whack as they were at the very pinnacle of the tech bubble. Apple's trading for 20 or so times earnings right now.
If that concentration is less now, what about the performance? Is the fact that it's being driven by just a couple of names, is that unusual?
Well, it's not entirely unusual, and what you see is, if you look at the distribution of just stock returns across the entire stock market over long periods of time, most of the market's long-term historical returns have been driven by a small minority of stocks. Many stocks fade away, disappear entirely. Others produce returns that are worse than you might get in treasury bills. So the fact that a small minority of stocks are driving the majority of the market's returns, again, feature, not bug, as it pertains to cap-weighted indexes and the funds that invest in them.
Overall, then, if you're an investor, you've chosen cap-weighted indexes, there's nothing going on today that should make you question that assumption as long as you knew what you were getting into when you bought them.
No need to question the durability of the proposition of investing in cap-weighted index funds. But again, inevitably, there will be a period where we've gone a bridge too far, where valuations get stretched. But what drives us towards that precipice and what results once we've reached that precipice is not going to be the same factors, the same confluence of factors, macro, micro, fundamental, you name it, as we saw in the tech bubble, as we saw with the Nifty 50, as we saw going back through various sort of mania from times past. So it's important to understand that there will inevitably be points in time, like the tech bubble, where cap weighting ex post, in hindsight, looks like a bad idea. It's going to inevitably happen again. What matters more than anything is that investors are aware of this, they understand this, and they can accept it and stick with this particular strategy, if it's their strategy of choice, through thick and through thin.
Ben, thanks for your thoughts today.
Thank you, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
And finally, 2 undervalued REITs.
We have increased our fair value estimate for Federal Realty to $141 from $138, and we have increased our fair value estimate for Kimco Realty to $1770 from $1580. As a result, both companies currently trade at discounts to our fair value estimates. Additionally, we point out that Kimco currently provides a 6.7% dividend yield, one of the highest yields among U.S. REITs for income-oriented investors. When analyzing shopping center REITs, it is important to distinguish the rent that will and will not be impacted by e-commerce. Tenants that compete with online options, which include segments like apparel, home decor, and electronics, make up 35% of Federal's base rent and 44% of Kimco's base rent. While e-commerce will continue to grow, which will pressure sales growth at brick-and-mortar locations and force store closures, the negative impact will be greatly weighted towards the lower end of the retail quality spectrum. Federal's portfolio has the highest average income and population density of all retail REITs, and Kimco has actively improved these metrics over the past decade. Retailers, even struggling ones, are looking to keep their profitable stores in Class A shopping centers that have the dynamics to produce high sales per square foot. However, most of the rent for these companies come from tenants insulated from e-commerce, which includes grocery stores, restaurants, fitness centers, dollar stores, autos, and entertainment tenants, as these segments still require consumers to shop directly at the store to get their product. Even as online options penetrate these segments, the physical store will remain the distribution point, driving sales and traffic to the center. Overall, we expect low but steady and positive sales growth for shopping centers, leading to declining but still positive releasing spreads and internal NOI growth. Combined with a slowing disposition program and an increased focus on redevelopment projects at 7% to 8% yields, we think that these companies should continue to steadily grow over the next decade.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.